Hey guys, welcome back to another video on the Reaction channel, and today we're here to talk about the possibility of a rate hike this upcoming Fed meeting and also what I think is going to occur in the market for the rest of this week. So if you guys do enjoy the reaction, also we're going to be reacting to a video today about someone speaking on if he thinks a rate hike is going to happen, and it seems like he thinks it is. So let's get right into it. The market is up 7% year to date. What's next? Nobody knows. Polymarket odds for the Fed decision in June point at very much no change. We see an increase or a decrease is priced in at literally less than 1% chance on both of those. So very probable that there is no change. Polymarket tends to be insanely accurate because the way that the odds work, it is very easy to get a pretty accurate prediction out of this market. And we see the odds are increasing for a hike the farther that we go through the year. If we see right here, July 29th, people are expecting no change with 94%, but a increase is a lot higher than a decrease when it comes to the probability. We see 25 basis point increase is a 5.1% chance, and now we're actually pricing in, it looks like a 12% increase in September, or there's a 12% chance that there will be a 25 basis point increase in September, but no change is the overall, broad guess in that. A lot of people have a lot of money in this, so there's some thought out plays, but inflation is almost out of control. So we see the times where it has gone out of control have been, major events in the world, like the 2008, obviously when 2008 stock market crashed, everything crashed. Then we look at 2000, the dot-com bubble, inflation was at, pretty much an all-time high. When I look at this too, I'm only accounting for the past 30-ish so years. I put a red line right there because I don't want to, account for inflation in 1980 that I think is kind of obsolete to what we have going on today. But we do see that, COVID inflation was crazy leading up to. We see just right now, inflation is right on the rise again in its cyclical fashion, where it could stay this way for a while if we're leading up to what the dot-com bubble was. If we're, doing what the housing crash had, then inflation could be this way for a very long time. But oil price tends to rise in times like this. So, it's not exactly the same, but similar graphs when you look at oil price and inflation. And this is the past, since 1986, and this is since 1955, so different graphs, but you look at them and they're pretty similar. When inflation kind of drives oil prices as well. They go hand in hand, obviously, but we see right after COVID, oil prices were crazy. They began to come down a very good amount, and they've just had this recent spike because of the geopolitical tensions in Iran and the Strait of Hormuz being closed for such some time now. So that's something to consider as well. There is a lot of factors pointing towards maybe a rate hike, and that might be the right thing to do in the economic state of America, but is the right thing going to happen? Maybe not. NVIDIA, this is a big if, but if NVIDIA misses their earnings tomorrow or they give poor guidance, I don't think they're going to miss their earnings. I think that's not, with the state of the market that we're in, that's not even a possibility that they miss earnings. Poor guidance, I think, is a very small possibility, but if either of these happen, the market will tank. This is going to be, if either of these happen, if NVIDIA comes in and there's some numbers that don't look 1,000,000% promising, then inflation fears are going to set in. The oil price is going to matter. NVIDIA is the big, the beholder of AI. This is the big one. This is the one that everyone looks at. So if they come in with something that isn't exactly what it needs to be or better, then it's gonna, you're gonna feel the gas prices. You're gonna feel the actual inflation fear set in because AI is the only thing holding the market up at its 7% year to date right now. So take that into account when investing. But now we're gonna get into the reaction video for today. It's why Ed Yardeni is expecting an interest rate hike in July. So let's get right into it. If you guys do enjoy this, remember to like and subscribe to the channel. Let's get right into it.
From one of the most followed market watchers, Ed Yardeni, says we could get a rate hike in July. Let's get more now from the man himself. He's the president of Yardeni Research, and he's with us live. Welcome. It's good to talk to you.
Thank you.
So you turned some heads today because you're such a bull in this market, and you stay with your target of 82.50 for the end of the year. But you think the Fed could actually hike rates in July?
Well, I think the bond market is calling for that.
I think this is something that we do see. 100%. I'm not sure when it'll happen this year. I think July is a little soon, but I think if this continues and rates will hike, and the fact that he's still bullish and guessing for, or calling for a rate hike is a pretty interesting combination.
Bond yields have gone up is because the perception is that the Fed is behind the curve on inflation, and the Fed has to clearly show that they're dropping their easing bias, which is what they had in their April meeting, and move not to a neutral bias, but move to a tightening bias at the June meeting coming up in a few weeks.
And to be transparent, the president does not want to, have a rate hike. That is the last thing that he wants. And if we saw the economy crumble or take a big hit because of that, it would be very sad. But I could see that happening.
And then after that, I think they have to follow up and actually show that they're willing to raise rates and do it by 25 basis points. The 2-year is now indicating that the federal funds rate is too low. The federal funds rate range is 3.5% to 3.75%. The 2-year is at 4.1%, and it's a pretty good leading indicator of what the Fed should do, and very often it gets it right.
So you're one of those in the Fed follows the market camp, it sounds like.
Well, I think the Fed doesn't really want,
which they probably should do,
want to get behind the market. Being behind the market is being very much behind the curve, because the market is certainly looking at the CPI and PPI that just came out, and there's a lot of concern that we're back into an inflation mode comparable to 21, 22. I don't think it's anything like that. I don't think we're going to have another bear market the way we did in 2022. I think the stock market can handle a rate rise in the bond market. Well, right now it's at 4.6%. It's sort of at a critical level. If it goes higher than that, then I think the next stop is going to be somewhere around 4.75%. I don't think we're going to go to 5%, and I don't think these are the kind of rates that are going to really create a problem for the economy to grow and for earnings to grow. So I see earnings continuing to do well. I think that we are going to.
And I don't think rate hikes are a big deal for the economy. I think we are going to see earnings continue to grow in these AI stocks, no matter if the rate is hiked or not, because this is probably going to affect the consumer a lot more than it will the cloud, so per se, but that's something to take into account as well.
See some tightening in credit conditions here because of the inflation issue, and I don't think that's going to create a real big problem for the valuation multiple either. It's not a perfect correlation between bond yields and the valuation multiple, and I think the market's still very much focused on the very futuristic developments that are happening now in the whole AI field.
Ed, I'm just going to read you. We're not naive to the moves in the market as we were having this conversation. Guys, let's put up the S&P if we could, please, because that's what we need to see. Can we see that, please? The intraday? There it is. This is on a Truth Social post by the president, who says, I've been asked by the Emir of Qatar, the Crown Prince of Saudi Arabia, and the president of the UAE to hold off on our planned military attack of the Islamic Republic of Iran, which the president says was scheduled for tomorrow, in that serious negotiations are now taking place.
Heard that before. This war seems like it's going to go on forever as of right now, but it's good that we're getting a little bit of at least a little bit of news there. There's a lot of time where there's no news, so I'm glad to hear that, but at the same time, it is a Truth Social post, which you can not take 100% seriously. You probably need to take that with a grain of salt.
So we'll continue to follow that, but sure. Ed, this just shows you how sensitive the market is to this issue, right? If you're going to have yields move up and oil move up and attacks move forward, this market's probably not going to take that news all that well, especially at a time where some would suggest the stock market was ripe for some degree of pullback anyway. You just needed the point to which it was going to initiate that, right?
Yeah. Look, I don't really have a problem with the notion that the market takes a pause here. I think it's a good thing. I wouldn't want to see the market continuing to move straight up, led by a narrow group of stocks, led by the Magnificent Seven and led by the semiconductors. I like what I'm seeing today. I like that some money is coming out of some areas of tech that have done very well and going into software. I think that's a good development, a sign that of a kind of a healthy broadening out in the market. And we have seen the S&P 500 index outperform the S&P market weight index. And I think some broadening in this.
We see the S&P outperform because AI is so heavy in there. You look at the tech segment, it's almost 40% of the S&P. So that's why it is outperforming the overall broad market. No surprise there.
Market is appropriate, especially since the underlying earnings picture really is broadening. It's more and more companies, according to analysts, are looking better and better on the earnings front. So I don't think we're going to have a pullback anywhere near as severe as what we had in March. That obviously was when we had the shooting war in the Middle East. It certainly looks to me as though the president does not want to start another round of shooting. And we may just have a status quo where the Iranian ports are blockaded and the Strait of Hormuz is blockaded. Meanwhile, the big surprise is that the price of oil has actually stayed pretty reasonable at $100. I know that sounds odd to say, but
I disagree.
It's not 125, 150, 200. I think some of that is because, fortunately, the Chinese economy is looking pretty weak. The retail sales report that came out just recently was very, very weak.
That's all we have for today's video, guys. So if you did enjoy, be sure to smash that like button. Also subscribe to the channel. Thank you guys so much for watching. And it'll be an interesting day tomorrow for NVIDIA's earnings. I'll catch you in the next video tomorrow. Peace.